Good morning, everyone. Good afternoon, everyone. This is MOOC 12, Session 8. I'm delighted to be back. I hope you had an excellent 6 sessions with our colleague, Andreas Antonopoulos. And I'm now back for the last 5 sessions, where we're going to discuss some of the more economic, legal, regulatory aspects. I want to say, last week we had a really wonderful week here at the program. We held the decentralized conference. It was our 3rd one. It was super interesting. We had some great speakers. We had some great technologists, and it was really a magical experience. And so at some point in the room when we were having a presentation of the 8 references in the Bitcoin white paper, the authors of 4 of the 8 references were in the room with us. And so it's always wonderful to have that type of crowd around. We will be running the conference again next year, November 12th and 13th, 2020 in Limassol. So I am giving you a mark your calendars now with a year's worth of notice, so no one can say that they scheduled something else in advance. Now, we have some questions here about central banks, about monetary policy. I will answer them. I don't know if it will take up the whole time. If it doesn't, we'll go to the chat and see what else we can discuss. First question. I don't really understand how monetary policy is embedded in the Bitcoin protocol. I can see coin issuance and a payment transfer system, but not monetary policy. Can someone provide some explanations and examples? Yeah, look, it's a definitional question. There is absolutely a monetary policy embedded in Bitcoin, and it's just a very simplistic one. So the reason it doesn't look like the monetary policy operations of a typical central bank is that there's not very much discretion to the monetary policy. It is closer to what you used to see in banks as a gold standard type policy, that it was a fixed approach. It was not an approach where, in a modern central bank, the governors meet and they look at economic conditions and they look at domestic conditions and international conditions and fiscal policy and a variety of indicators, and then based on that try to make a decision on what the monetary policy should be in order to meet their various objectives, usually price stability, a little bit of inflation, full employment or close to full employment, general system stability. And some of these are of course contradictory, like it's easier to generate growth by also generating inflation. It's having a loose policy hurts employment rates. Having a loose policy helps employment rates, hurts inflation expectations, and so on. And so there's a lot of discretion and tough decisions, and they look at indicators and try and decide what the right thing to do is. With Bitcoin, it's different. The monetary policy is that every 10 minutes, a certain number of Bitcoins are issued. Over time, the issuance falls every couple of years or so, depending on the hashing rate. They fall in half, and over a long enough time, it diminishes to close to 0 issuance, though that is quite a ways away. So today, it's still, you're issuing 3-4% of the base on an annual basis. With the next halvening, it's going to go to about 2%. It's going to start looking like a fairly typical issuance rate for even a national currency. And then 2 years later, it'll fall in half again. And then 2 years later after that, it'll fall in half again. And so it is a monetary policy. It is an explicit monetary policy. It is a transparent monetary policy. It is not a very complex monetary policy, and it's an algorithmic monetary policy, which is why it doesn't look like what a central bank does, but it is serving one of those central banking functions of managing the supply of the currency. That's one bucket. The second bucket, that the other central banking function that you more or less see it deliver, is a payment system. Beyond that, I think that's it. It is not a lender of last resort. It is not a regulator. It is not working with commercial banks to ensure a steady movements in the economy. It does not worry about unemployment. It does not worry about impacts on fiscal policy. It does not worry about international relations. It is simply a monetary policy and a payment system. And so it's a very stripped down central bank if you want to look at it in those terms. Okay. Next question, or I'm not sure if it's the next question or it's somehow related. How to implement, I think the question is how to implement monetary policy and interest rates in the presence of a CBDC, so a central bank digital currency. This is an interesting question, and I think it has a lot to do with how the CBDC is implemented. You could imagine a CBDC being implemented that has exactly zero impact on monetary policy relative to whatever the central bank was going to do anyway. I think this is how I would have implemented a CBDC. So imagine that you're the Federal Reserve and the money supply is whatever it is, and your targets for the money supply are whatever they are, and this is some number measured in the trillions of dollars. And let's say you also wanted to have a tokenized dollar for reasons that we'll discuss later in this session. But let's just, for the purposes of this question, let's say you want to have a tokenized dollar. You see value in a tokenized dollar, but you don't see value in changing the monetary policy of your country. What I would do in that case is issue, $50 billion of CBDC dollars, tokenized dollars. I would subtract it from my other money supply, right? You take your operations, take it out from there, and have a model where you can say, look, you can trade them interchangeably for a non-tokenized dollar, whether a digital or physical dollar. So you're a unlimited buyer and seller at exactly $1. So you maintain the value of the token at $1 because that's in fact the whole point. The only entity that can truly guarantee a 100% stable coin US dollar, 100% US dollar that is matching the price of a US dollar at all times, is the Federal Reserve, because they're the only ones that can for sure buy and sell in unlimited quantities versus physical or digital non-tokenized dollars, and they're the only ones where you don't have any counterparty risk on the question of dollars. They're the issuer of dollars. They won't run out of them. So at that point, you have in your money supply your 50 billion of tokenized dollars, and then you just carry on doing whatever you're going to do anyway. So there's no reason to believe that if you're going to tokenize the dollar, you should change how you manage your money supply. You should change how you manage your monetary policy, because presumably you have reasons that you have monetary policy that the way you have it. It is very possible, in fact overwhelmingly likely, that the reason you're going to have a central bank-backed tokenized dollar or euro or yen or what have you is not because you've suddenly decided your monetary policy is wrong and you want to go to a fixed algorithmic monetary policy, right? Like that, there's nothing preventing central banks from going to a fixed algorithmic monetary policy today. They don't need tokens to do that. They could just say, this is our new monetary policy, and we're going to stick to it thick or thin. It doesn't matter what the economic conditions are. This is what we're going to do. And the reason they don't do that is because they don't think that's the right thing to do. They don't want to do that. It takes away flexibility. There might be scenarios where this is a useful thing to have that flexibility. So creating a way to have digital tokens that represent value and represent things that you have to have trust in doesn't change, as far as I can tell, any central bank's theory about the right monetary policy to pursue. Why you would issue a digital token, a digital version of your sovereign currency, however, is for other reasons. It's for, let's call them operational reasons, call them payment reasons. Think about all the reasons we have, all the different usage cases we've discussed for Bitcoin. And think about all those usage cases without the currency risk. So that, to me, is why you would have a central bank-backed tokenized digital currency. It's programmable money. It's machine-to-machine money. It's digital push payments. It's digital cash. So all the ways that you can use Bitcoin that you can't use non-tokenized money could be adopted by a national sovereign tokenized currency. And you can do all these things without really having any view that your monetary policy needed to be any different. In fact, if it's a stable coin, your monetary policy is going to stay the same, right? It's just you're not saying that because of tokens we expect inflation or deflation in the dollar to be any different. We're just saying we can now represent a US dollar in a third way. The first way is digitally in a centralized ledger. The second way is physically, analog-wise, in notes and coins. And the third way is, again, digitally, but as a token in potentially a decentralized ledger. So this is how I view it from the monetary policy side, and we'll come back if there's other related questions to this. It's a very funny question. What are the differences between the BIS, the Bank of International Settlement, and the World Bank? And please, which is the most epic bank? I don't know how to answer the second part of that question. In the epic bank trade-off between the BIS and the World Bank, that might not be an answerable question. But we can discuss what the two are. The World Bank is a development agency, in effect. It funds projects around the world for development projects. And the BIS is a combination central bank to the central banks, so it provides some payment and settlement services, and also a forum for central bankers to get together and be their own very elite club of central bankers. So they are very different type of institutions. One is a promoter and investor in public infrastructure around the world and development, and the other is a central bank for central banks, and in my opinion also kind of a lobbying group for central banks, or a club for central bankers. So the which one is more epic, I will leave to the class to sort out. Now, I saw a comment in the chat that says, well, it's a little strange to define a stable coin as something that's lost a lot of its value over the last 100 years. And here's what people mean is lost a lot of their value relative to inflation, relative to gold, relative to some type of fixed entity. And they'll say, oh, there's been inflation, and so relative to gold, or relative to eggs, or relative to land, the US dollar has lost its value. But that's not what people mean about stable coins, right? When they say stable coin, the stable doesn't refer to it has some fixed unit of value relative to the physical world. What they're defining stablecoin in the world of cryptocurrency and digital currency is that it is stable relative to the currency it is meant to represent. So a stablecoin euro needs to track the euro. A stablecoin dollar needs to track the dollar. A stablecoin yen needs to track the yen. And the euro and the yen and the dollar might move around relative to each other and relative to real goods at any point in time for any reason. But that's a different topic. That's not solved by tokenization. That's not solved by digital currency. That's kind of a macroeconomic issue. And then if you want units, stores of value that go across different dimensions that are not tracking the dollar or the yen or the euro, well, you can have either tokenized real assets, gold, oil, whatever, or private currencies like Bitcoin, or private commodities like Bitcoin, that has, you can argue what its store of value is, if it's good, bad, indifferent, volatile, not volatile, but it's certainly not stable relative to a dollar, yen, or euro. It's on a different dimension. So from a definitional, terminological perspective, that's usually how people think about it. Okay, what do we think of the IBM recent report, October 29th, 2019, that CBDCs may become a reality within 5 years, in spite of a number of central bank leaders predicting the contrary, as seen in this session's reading? I have a strong view on this. I think the environment is changing very rapidly. I think this will be outdated by the next MOOC. As far as it seems, China is full speed ahead to launch a digital yuan, and we'll see what the actual implementation of it is. It's certainly not going to be decentralized, as far as I can tell. I think it's going to be consistent with the overall Chinese digital infrastructure, that there are centralized controls, but it will be some type, it seems, of tokenized digital currency. Well, if so, then a world that has the second largest economy with a tokenized national currency active in the first quarter of 2020, then all of these things of 5 years away becomes relevant, right? Like, I mean, it'll be happening. I'll tell you, I have had lots of conversations with large service providers that are working on blockchain projects, and they, behind the scenes, not publicly, are quite bullish that some other banks are going to do things. There's a lot of trials in place. There are a lot of people dancing around the topic, and it might be a situation that once China moves forward, then other people will accelerate their efforts. And so I do not believe it's going to take 5 years. I think we're on pathway to have the first one next year, and once we have the first one, over the next 2 or 3 years, we will have other ones. I think it will be viewed as a necessary part of your digital and payments infrastructure as a national country, to have a digital, but not really digital, tokenized representation of your currency. And this leads to one of the other questions, and I think it's an important point that's often missed. U.S. Congressman Warren Davidson explained in a tweet that tokenized does not equal digitized. Can you please re-explain? And I will say, I'm impressed that U.S. Congressman Warren Davidson, in fact, was tweeting on such a technical level. And I went and looked at the tweet, and I hadn't seen it before, and in fact, that is what he said. Huge part of our existing financial system is already digitized. People might look at cash and think that, oh, look, and you hear this sometimes and say, oh, paper is going to be dead, cash is going to be dead, it's going to be replaced by Bitcoin. But in any developed economy, cash and paper is already dead. Like the majority of the money supply is not sitting somewhere in a bank vault or underneath anything underneath people's beds or in their safes in notes or coins. The majority of the money supply is represented digitally on either central bank or commercial bank ledgers, which are databases, which are digital. And when you move $10 from your account at Bank of America to someone else's account at Bank of America, nobody's taking a $10 bill and moving it, right? It's just some entries in a database. So national currency is highly digitized already. What we're talking about here, though, is tokenized currency. And that is something different because it is not on one centralized ledger. It can be moved around. You can't go and take your electronic deposit from your bank account and move it to an electronic personal wallet today. You can move it to another bank or financial institution. You can send a wire transfer, an ACH, or a faster payments, or a SEPA, depending on your region. And then it moves from one centralized database to another centralized database. If you want a decentralized own your own keys version of it, you can make a cash withdrawal, and now you have cash, and cash has all the exact same pluses and minuses of a cryptocurrency, right? You don't have any counterparty risk because you're holding it. It's not a liability on someone's balance sheet that they need to pay you. You're holding the cash. On the other hand, if you lose it, it's gone, right? If someone steals it, it's gone. You can't call up the central cash hotline and ask for it to be reimbursed. So a tokenized currency presumably has these characteristics, that you can move it from wallet to wallet. The wallets are at the end user level. It's machine readable. It's machine programmable. It's what I would think of as a tokenized currency. It does not mean, by the way, that it has a certain monetary policy. I think that's an important point because I suspect we're going to see all types of confusion on this topic over the next few years. That's not what I believe it is. The interesting question is how China is going to implement this, because that's coming very, very soon. And I'm going to use this to lead into another question: the privacy and anti-money laundering issues of a CBDC. One challenge is the appropriate degree of privacy of the currency would need to be considered carefully, which could entail difficult public policy design choices for a central bank. To date, it is not clear how MAL CFT requirements can be implemented practically for anonymous forms of CBDC. This is correct. These are, in fact, the difficult choices. I had a discussion with a senior official in the Federal Reserve years ago about this topic, and I said, why couldn't you do a truly decentralized one where you can move it around and it's just like Bitcoin, but it's denominated in US dollars, and people told us that it's very, very difficult. I said, but you have cash today, right? Like it's not like we operate in a cash-free environment, and somehow it's tolerable for central banks to have cash payments and cash transactions, and cash remains the number one risk by far for money laundering. And the answer was that no, he thought it would be politically very, very difficult to do that. And I guess I can think of two reasons why, which are the same reason but said differently. If cash didn't exist today, it would probably be hard to invent it, right? If everyone was just using digital representations of money and you had the whole AML, KYC infrastructure in place, and someone said, great, let's make a bearer instrument of our national currency, and it'll be little bits of paper, and you can carry it around, and you can do whatever you want with it, and it can get stolen, and it can be used by anyone in the world, including bad people, I think it would not be accepted as a concept. It would be very hard for policymakers to accept it. It would sound scary, and I think they wouldn't do it. And so the fact that it predates the digital infrastructure is probably why it's still there. It's there, and so it's kind of grandfathered in. A second theory, which is not hugely different from the first one, but is a little bit, I think there's a lot of banks that are trying to get rid of cash. So if I'm a central banker and I'm saying, well, great, we have this existing issue with cash, there's going to be a ton of psychological resistance to eliminating it for both lowbrow and highbrow reasons. Is it really a good idea for us to now go introduce a new form of cash and then create a new problem that we don't already have? Now, you can argue about whether or not central banks should want to eliminate cash or not, but that certain central banks would prefer to eliminate it, I think there's no question about that, or have tendencies in that way. There's no question about that. Now, why do they want to eliminate it? And I think they want to eliminate it both for payment controls and for monetary policy flexibility. Well, what do I mean by that? Right? Payment controls is pretty straightforward. You want to say, imagine a world that only had centralized digital currency and there was no cash, and you had a global, well-managed, interoperable, centralized system. And you said, well, someone anonymous wants an account, wants money transferred to them. You can just say, well, no. Or you want to implement sanctions on some country that you have a political problem with, or a set of individuals that you want to sanction. You can just cut them right out of the system. Say, look, I'm sorry, your payments don't work anymore. Your bank account doesn't work anymore. It's been frozen. So that, in and of itself, is a very powerful tool of governmental control, and the more centralized a system is, the easier it is to implement it. The other side is monetary policy. We have been I think breaking new ground in monetary policy recently with negative interest rates. I did not expect to see this. In fact, it's funny that a lot of the people that believe in Bitcoin for monetary reasons have all been predicting high inflation, hyperinflation. We have the exact opposite. Now they say, well, it's because the banks are absorbing all the debt and it's going to come back and bite us in the end, and it might, but right now, interest rates are staggeringly low, and there's something like $17 trillion of negatively yielding debt. In other words, where if you go buy it today at the price you buy it today, and you get the interest payments and the principal payment at the end, if everything goes well and your counterparty does not default, you will still lose money. The interest rate for your money will be negative. So, why is cash problematic in this world? Well, someone might say, well, if the best case scenario, by me putting money in a bank account or lending money to a national government, is I'm for sure going to lose money, maybe I should just take my money and stuff it under my mattress. I got to make sure nobody steals it, but at least I'm not losing 0.5% a year to negative interest rates. At 0.5% a year, probably not too many people are going to do that, right? It's still, the risk of storage is still probably outweighs it. But let's say you went to negative 1%, negative 2%, negative 5%. At some point, people are going to say, oh, no, I don't like this at all. I would like to hold on to cash and pay negative 0%. And so if you can eliminate cash, if you can keep everything in a digital format, well, then you can implement negative interest rates across the whole money supply, because you'll just say, well, you have 100 units of X, and every month I'm going to take a tenth of a unit away from you, and you'll just program it into the system, program it into the bank, and bit by bit your money will go away. And so you can implement much more deeply negative interest rate monetary policy so long as you've eliminated cash. And this is, again, for the existing cash. If you now then say, well, I am going to make it very convenient for people to have digital cash and create this problem all over again, that sounds like something a central bank might not want to do. So I think we will see, at least at the beginning, that the central banks that will do CBDCs will maintain some type of centralized control. I don't know if it's a kill switch on certain payments. I don't know if it is avoiding of anonymous wallets. Right? If you have to show ID to create a wallet and you have some type of censorship mechanism, then you could say, okay, well, this is fine. Everyone has their account. It kind of looks like a bank account. If I want to sanction Antonis, I can sanction him. I can cut him off from payments. If I want to freeze his account, I can freeze his account. I can stop him from making payments, and so on and so forth. And is this useful? If it's tokenized and you can program with it, yeah, it's still useful. It allows you to do things that otherwise might need to go through the API of a bank. API is the application programming interface of a bank. And going through the API of a bank is something that is sometimes difficult with banks. They might not want to approve you. They might have certain requirements. They might not broadly open it up. So I think there's still value in having a tokenized currency, tokenized CBDC, even with some of these controls. So, okay. Will we see a bank do a decentralized version? Will we see a bank do a truly decentralized Bitcoin-like, the bank lets go of control and just is there to redeem or sell as needed? I don't know. That would be fairly radical. That would be a bank saying, look, I'm actually issuing digital cash. I am actually making my currency appealing potentially to users around the world who do not want censorship resistance possibilities on their currencies, right? And will the competition between currencies create that? I don't know. It's a tough question. So, I mean, here's the question to ask yourself, right? Like, if I'm the Central Bank of China, and I think it's the People Bank, so PBOC, People's Bank of China, it's obvious why I want censorship ability on my digital currency. On the other hand, and if I'm a citizen of the PRC, probably not going to have much of a choice if I want to use this tokenized currency, so that's fine. Like, I'm going to accept it. If I'm a third party, if I'm not a PRC citizen, would I want to store a large amount in a PRC censorable payment system, an EU censorable payment system, a USD censorable payment system? Depends. If I'm comfortable today having my money in a bank from one of these locations, yeah, then sure, what's the difference, right? Like, I mean, if you use banking in the United States or banking in the EU or banking in the PRC, of course, one day a court order could come and your assets could be frozen. If you're not comfortable with that, and what's the usage case for not to be comfortable with that? Well, everyone thinks of all the very dramatic ones, right? Like, you're running blood diamonds out of Africa to trade them for uh, illegal drugs, and all these very scary scenarios. And sure, that's one type of user, but there's also people who are afraid they're going to get caught up in political risk or geopolitical risk. As you've noticed, or may have noticed, the United States and China are in a game of some tit-to-tat censorship of each other's companies, blocking them from doing certain things, blocking them from M&A transactions, blocking them from buying components from each other. Let's leave aside the merits on if that's a good idea or a bad idea, or who's right, who's wrong, because none of that matters. For the purposes of this discussion, I think it is fair to say that if you are a politically sensitive American or Chinese entity, you might want to limit your exposure to the banking system of the opposite side, because you might conceivably get caught up in a fight that's above your pay grade, and then there's nothing, and you'll just be a victim of that fight in one way or another. So, will there be a market for central bank backed stablecoin tokenized decentralized currency, censorship resistant currency? Yeah, there's probably some market for that. Will a major economy go for it? I don't know. I don't know. If I had to guess, if you put my hand in the fire and said, you've got to pick, you can get one shot, my guess is no. My guess is that the central banks of major countries will say, it's probably safer not to create a digital cash, a cash 2.0. I'd rather maintain some control of the system. Implicit question I'm sometimes asked, which of the two scenarios is good or bad for Bitcoin? I mean, difficult, I don't know, but probably it's better for Bitcoin if the national governments launch censorable currencies, because one of Bitcoin's proposition is that it's uncensorable. That's kind of the good thing about Bitcoin. The bad thing about Bitcoin tends to be its volatility. And so the stable coins will definitely be stable. And so if you say, well, all right, I want to opt out of, you can opt out of one of two things, right? The monetary policy or the censorship capacity of a payment system. If there are censorship-resistant national stablecoins, that takes away some usage case for Bitcoin, because I think the people who care about the censorship resistance aren't necessarily the ones who also care about the monetary policy, right? You could think Bitcoin is a great source of value and it's deflationary and you think it's going to go up in price and not particularly care if it's censorship resistant, or vice versa, or both, right? Some people will say these things do in fact go together, because if it's not censorship resistant and it goes up in price, it's going to get confiscated at some point. I'm not sure I believe that, but it is a point of view. But I think it won't be the big countries. It might be a smaller country, but I think they will tread cautiously. What I suspect we will see now are tokenized CBDCs with some level of centralized control. I do not think it's in 5 years. I think it's in 1 year. And I think in 5 years there will be many implementations of this. So I suspect the moving of events means this section is going to get rewritten extensively for the spring 2020 MOOC. Okay. Why is Ripple so popular with the banking sector and the central bank? Well, I don't know how to mathematically say how popular it is or isn't. What I can say is Ripple has been explicitly targeted to this sector from the beginning. Its proposition is that it can be some type of SWIFT 2.0 for settlement among banks across the world, among financial institutions across the world. And so it was designed with this in mind. It is the strategy of the top level executives and there's a team of folks whose job is to go work with banks and go work with financial institutions to convince them to adopt Ripple. So I think that's actually just a deliberate strategy choice of what Ripple was designed for. And so it's to be expected that you see a lot of activity, or when you hear about Ripple, you generally hear about it in a banking context. Now, there's some other uses you can imagine Ripple for, but it is heavily oriented towards the banking sector. Okay. Complicated question. Here comes a complicated one. I am just wondering how we can achieve a new form of financial freedom and go from exclusion, as we can see intensifying in the banking world, with the pretext of security, AML, KYC, and all the other hurdles thrown in our face, to a free world without gatekeepers. The latest repo action by the Fed shows how fragile the whole thing is. Every day we're on the verge of financial disaster. Big institutions are handed out free money by the billions, and we are stuck with the bill, be it through new taxes, more hassles, theft of purchasing power, negative interest rates eating up our savings, etc. I would go even a step further and say we are at war. If I look at countries like Greece, Cyprus, Italy, Portugal, Spain, Iran, Argentina, Venezuela, and the destruction that happened there over the last few years, I can't find a more appropriate word than war to describe it. Sure, with the exception of Iran, there were no bombs exploded, but the financial means of mass destruction have been applied en masse. Any concrete suggestion to come out of this mess? The search for the answer has driven me here. Okay, well, this is a political question, not, a technological question. It's a political question that many people in this field, or who are drawn to this field, have concerns about. I would say that to some degree these issues are theoretically solvable even in the existing system. Any monetary decision, just like any fiscal decision, has winners and losers. Right? There's no free lunch. You're going to help savers or you're going to help creditors. You're going to help financial institutions or you're going to directly help individuals. In fact, when people help financial institutions with explicit or implicit bailouts, their theory is that, in fact, they're actually helping the common man, because if the banking system ran into trouble, it would actually cause even further problems for the real economy. And yes, it's an unfortunate side effect that maybe bank executives or shareholders don't get their comeuppance, but it's less of a problem than causing rippling effects throughout the whole economy. My job here is not to try and answer these questions. I mean, these are very hotly debated questions, but in theory, in a democracy, these questions are resolvable at the ballot box. They are resolvable by electing candidates who have one orientation or another on these topics. Now, the highly cynical view is saying, well, that might be true, but every politician does like the idea of running looser on these topics because it's more likely that they can implement their policy objectives, and the negative aspect, the corrosive aspect, the inflationary, the loss of purchasing power, the things that people with this view are concerned about, gets implemented in the real economy. It is diffuse. The losers are diffuse. The winners are obvious. The losers can't tie it back to the politicians per se. It just looks like it's something in the system. But again, in theory, you could resolve this even within one's own national system. Now, someone's going to say, well, okay, but practically speaking, everyone's pursuing very similar monetary policies, so obviously that's not the case, even though you have very different countries and very different political systems. And is there a way to decentralize some of this power? And again, broadly speaking, this power is monetary policy and censorship resistance. Among the two, I think the thing that's most special about typical decentralized cryptocurrencies is actually censorship resistance. The reason I say that is there are plenty of options. If you want to opt out of the declining purchasing power of the US dollar, you can invest in a variety of investments that are not cash and that have a different risk-return profile. You could buy stocks, you could buy bonds, you could buy woodlands, you could buy gold, you could buy oil futures, you could buy any number of things. And then you would have a different profile than someone who isn't just holding cash. And none of them are going to be risk-free returns, but there's nothing in life that says you're guaranteed a risk-free return, right? Like that. There are no free lunches in the universe, including risk-free returns. And cryptocurrency is also not a risk-free return, right? Cryptocurrency goes up and down and left and right in all types of directions, sometimes very rapidly. It's a lot of things, but it's not risk-free. So if you want to opt out of your country's monetary policy and you have some liquidity, you sort of can today. Now, people don't. People have a home country bias, what's one of the strongest findings in behavioral finance, that people hugely over allocate to their home country. So if you're American, your salary typically comes from an American company, your largest physical asset is a home in America, you invest in primarily in the American stock market and possibly the American bond market. Oddly, and you can say, well, it's America, it has the deepest capital markets in the world, that's a good idea. Fair enough. But then you go to Brazil, and in Brazil, it's kind of the same. And you come to Cyprus, and it's kind of the same. So if you look at someone in Cyprus, they might have a salary from Cyprus and a house in Cyprus, and then they have some extra cash available, and maybe they'll buy some shares in Cyprus or buy a rental apartment in Cyprus. And so people do have a significant home country bias in a way that they wouldn't, and the easiest way to think about it, right? And by the way, this is an interesting learning for you individually, because most likely our audience also has a home country bias. I have a home country bias. I know the whole theory, and I still have a home country bias, and so this is one of those that, like, you have to fight strongly against if you want to fight it. So the way I ask people to think about this question is, let's say you're advising, I don't know, the Norwegian Sovereign Wealth Fund on where they should invest their money for the long-term economic benefit of the Norwegian people. And I say Norway because they have a very large sovereign wealth fund where they've managed their petroleum wealth well. It's highly unlikely that you would say, all right, well, just load up on Cypriot or Greek or Spanish or Chinese or Indian assets. You would almost certainly tell them, well, you need to diversify around the world, and maybe you can make some bets a little bit more in some countries than others. But if you're in charge of the future pensions of the Norwegians, you probably wouldn't think it's a sensible decision to just go all in on Italy. But if you're Italian, you're probably pretty much all in on Italy. So there is, and then when something goes wrong in Italy, everything goes wrong at once. And they say, oh my God, my country is doing things wrong. We have a bad monetary and possibly fiscal policy, and they've ruined the economy, and now I have less money. And it's true. That's actually true. But in theory, you could have opted out to a meaningful degree in the existing financial system. But, parentheses, people typically don't. Now, censorship resistance, though, there's no equivalent in the existing system. Like if you told me rebalance my portfolio in the existing system, so let's say I'm in the EU, I'm in the Eurozone, I don't like the monetary or fiscal policies of the EU. Could I rebalance my portfolio of assets to opt out? Yeah, kind of. I mean, you could sell things in Cyprus and buy, I don't know, stocks and bonds in the US or in India or in China or in Japan, whoever you think is doing a better job. And I'm less exposed to the EU. Could I make a censorship resistance payment by opting out of the EU banking Target 2 SEPA system? No. When you're going to go to somewhere else, you're going to have the same issue. Like when US aimed to block payments to WikiLeaks, whatever you think about it, good, bad, and different, that they did aim to block it, they were able to, they called Visa and MasterCard and said, stop accepting payments, and then WikiLeaks said, all right, we'll take Bitcoin. And so some level of censorship resistance is, in fact, new in digital payments. And now people say, well, but it's bad. Why do you need this? Isn't it for bad people? Censorship resistance to me is like free speech. Most of the time, free speech is mostly annoying to everyone else, right? Like, if you have a country like the United States that has strong free speech protections, someone's going to come and march in your town square and say all types of like annoying things that you disagree with, and very objectionable things sometimes, and things that are kind of unhelpful to the public discourse, and you can't legally do anything about it because it's their right to say that. And that seems kind of bad in the short term, but it is an excellent safety valve for the long term because it is protection against some future government coming and saying, you can only say X. You can only say Y. You're only allowed to do this. This is the only politically acceptable discourse. And so you take a little bit of pain in the short term as a society to prevent something bad happening in the long term. I believe the censorship-resistant aspect of Bitcoin is kind of like that. It's mostly annoying to governments, I think. I don't think any government was thinking, oh, it'll be super wonderful if someone could develop a censorship-resistant payment system. Because if it was, they'd be more oriented to developing it themselves. But it's a safety valve. Like, in theory, the government is always working for the common good, but it has happened in world's history. It has happened in world history that sometimes that's not the case. And in the case that it's not the case, having these safety valves is important. Kind of one of the ways that I asked people to think about this is like, well, okay, you want X, Y, Z right. That's wonderful. Are you comfortable with like your sworn enemies having it and you being on the outside and they being on the inside? Because everyone thinks their policy prescriptions are right and should be enforced. But people tend to be a little bit less comfortable when the exact opposite side wants to enforce the exact opposite set of policies prescriptions. So I think leaving some breathing space in the system for, let's call it, dissent, just like with free speech, is probably long-term safer, not for a day or for a year, but over decades, and keeping a healthy society. So in this regard, I think cryptocurrencies are a step in the right direction. They are not a magical potion that's going to solve every problem. They allow you to opt out of a monetary system into a very volatile commodity. I mean, I think that's really what they typically are, which I'm not sure if that adds or doesn't add something to one's life, but it's an additional option. It's an option you didn't have before. They allow you to make censorship-resistant payments today, which is one of those things that for the average person is much more useful as a theoretical construct as more than it is going around your day-to-day life. You need to make censorship-resistant payments. I mean, it hasn't really come up in my day-to-day life. But I'm glad theoretically it exists as a concept. And over time, maybe you'll see more social decentralization, where tokens are used to organize people in a less centralized manner, in a more decentralized manner, and transfer value and align incentives. And I think that stuff's very exciting. It hasn't happened yet, except within the mechanical operation of cryptocurrencies, right? Like Bitcoin is kind of sort of like a bank, and it's a bank that doesn't have anyone in charge, and there's bank accounts and there's payments, and they get all organized through the incentives in the token without anyone necessarily knowing anyone else. You can imagine tokens organizing more sophisticated forms of organization, and incentives and alignments that are at a orthogonal to state infrastructure. And I don't know that we've seen it yet, but it's interesting. I do believe that on the whole, these decentralized cryptocurrencies are a force towards more freedom rather than less freedom, but it's not automatic. The state actors have a ton of power. The integration with the financial system is wholly in state hands, right? And so I think, like everything else in life, it's a little bit of good and a little bit of bad, and you take incremental steps. I don't think there'll be a magic bullet. I don't think there's something that suddenly dramatically changes how we're governed from one day to the next, either financially or politically or economically. But I do think these are steps in the right direction. So that's it for our time today. Thank you for your questions. Thank you for the participation in the chat. And I believe I'm not mistaken, we have a double session this week, and we will continue on Thursday. Thank you, everyone.